Good afternoon. There is a diagnostic test that if you're a business school professor you can use to find out what kind of crowd you're with, and I just used it. It goes like this. You say good afternoon sort of loud, and if it's business executives, they shout back, good afternoon. They've been just trained to do that. If it's MBAs, they don't say anything at all. If it's PhDs, they write it down. So I know I'm in a group of MBAs and PhDs. I respectfully disagree with Professor Hunter. I am much more optimistic than he about the possibility of, as it were, generic but profound moral concepts to lead us and unite us and integrate us. But I won't speak directly. I want to speak to that issue. I want to speak instead to the issue of the current financial crisis. You may note as we go on, though, that I'll be appealing primarily to generic concepts of fairness, of integrity, and my sense is that without these, regardless of our faith affiliation or community, we have insurmountable challenges ahead of us in the economy. I want to thank the Wheatley Institute. It's if I could use a metaphor, like the bright Utah sun. It is an institution that promises a lot of hope. Brad Agel, Richard Williams, the excellent staff, have all assembled here, with the exception of me, a remarkable group of people, many who should have some of the airtime that I've been given. You will have an opportunity to hear from some of these people in a panel discussion in just a bit. On September 15th, what I refer to as Dark Monday, we saw a radical reshaping of Wall Street and our nation's economy. Lehman Brothers fell to bankruptcy. Merrill Lynch was sold to its rival. Bank of America, AIG pleaded for $40 billion in government relief. Those calamities marched in step with a dismal parade, including the U.S. government takeover of Fannie Mae and Freddie Mac, and the sale of Bear Stearns, the entire subprime debacle. Today, 5 months later, on February 27, 2009, the Dow Jones Industrial Average stands demolished at half the value it had a year and a half ago. We rightly blame Wall Street leaders for bungling business decisions, for misestimating risks, overloading banks with single strategy portfolios. We now also rightly ask about government regulation. Where was it? Was it too lax? I'm going to leave aside regulatory issues here to focus on ethical ones. Of course, we need and certainly will get more government regulation. We've been slapped to our senses and reminded that in an important sense, a good part of banking is a utility. You have to keep the lights on. You have to keep homes heated. They cannot fail. And that's an important story, and one that we should investigate at some point. But the ethics story is at least as important, I want to submit to you, as the regulatory one. Recall that regulation always lags behind the knowledge that's inside an industry that it's meant to, the actions of which it's meant to regulate. The existing scheme of regulation, we might note, or even an intensified version of it, could not have stopped the current crisis. The new regulation we put in place after this crisis will not stop the next crisis because it will have been designed to stop this one. Sarbanes-Oxley was designed, as you probably know, to handle a crisis that had to do with accounting, in particular off-balance sheet entities, accounting for expenses in the WorldCom case and so on. That was yesterday's mess. Sarbanes-Oxley didn't slow down even for a millisecond the current economic crisis. The law regulating asbestos in the mid-20th century lagged horribly behind knowledge inside the asbestos industry about the dangers of asbestos, just as laws regulating banking lagged behind bankers' knowledge of the dangers of the leverage that they employed recently. So how about ethics? How is ethics a part of the Dark Monday story? Most ethical commentary, in my estimation, on the current economic crisis has been either obvious or misleading, and largely unhelpful. Critics lament irresponsible home mortgage borrowing made by consumers who couldn't afford the loans, self-serving judgments by rating agency or demand-driven loans pushed down from Wall Street entities. Others slam the greed is good mentality of Wall Street. The joke I heard the other day was that people are walking through a graveyard somewhere near Manhattan, and the tombstone reads, "A banker and an honest man." And the other quips, "Oh, I see they're burying two to a grave now." The deeper questions are about why borrowers were allowed to take out stupid loans, about how the rating agencies were lulled into complacency, and why the banks and lenders decided to make stupid loans. Still more important, the mortgage messes we're learning was only the trigger for the explosion of a much deeper set of munitions, including credit default swaps and securitized credit card debt. The list goes on and on. Loans made to private equity firms, hedge funds, etc. Even today, we have no clear idea of the character or the valuation of the so-called toxic assets that are held by banks. Consider the greed claim about Wall Street. Also unhelpful. Greed no doubt varies by time and place, but it's notoriously hard to measure. There's no study I know of, for what it's worth, that shows that greed is higher on Wall Street than it is anywhere else. Perhaps it is, but it's just terribly difficult to measure. And more important, it's been with us forever. Greed depends on opportunity and rationalization, and that's where the more subtle and important part of the Dark Monday ethics story begins. And I want to suggest that three patterns emerge, three incubators, if you will, of ethical failure that were critical in causing the mess that we now are living in. These are paying for peril, the normalization of bad behavior, and what I'll call tech shock, technology shock. Let's begin with paying for peril. Paying for peril is an expression I use to refer to the phenomenon of rewarding short and suffering long. Now, the students in the class were not around to pay attention to the savings and loan debacle of the early 1980s. But the problem there lay largely in borrowing short and lending long. And not too long ago, the banks were ensnared in the same kind of process, rewarding short and suffering long. Firms pay huge salaries and bonuses to managers for actions today, even though the firm's rewards or penalties for those actions happen tomorrow. These kinds of pay patterns encourage rationalization and bad behavior. High performance can be faked short term. There's a name that's coming commonly to be used to apply to this called the tail of distribution. A tail of distribution is basically a distribution where in any one of, say, 10 years, you have a very high probability of significant positive returns. But in one of those years, it's TBD. It's not to be determined. It's there be dragons. We don't know, but it's calamitous. But stop and consider the position of somebody who is paid on the basis of bonuses that are assigned in terms of, say, next year's performance or the valuation of the deal that's done this year. For that person, it's not irrational to make the gamble that they'll roll the dice and get the 9 out of 10 option. If they lose, it's somebody else's money. Did the savants of Wall Street have no idea what they were doing? Of course they did. Traders and others even had a name for it. It was called the free option. Traders, in effect, have a free option. If the trade nets them money, they make money and they get the bonus. If they lose, again, it's somebody else's money. So it's tails I win, heads you lose. Did the heads of banks have no idea the big risks their institutions were taking by making so many tail gambles? Of course they did. As Alan Greenspan remarked only a few days ago, they knew about the risk. They just thought they could get out in time. The second incubator, if you will, is what I call the normalization of bad behavior. Psychologists talk of the normalization of danger, and it's a phenomena that occurs when people live with danger long enough that it becomes sort of the standard, and people's guards come to be let down. Now, the normalization of bad behavior is a phenomena that I've witnessed throughout my career in business ethics, and I think it's one of the most powerful phenomena I have encountered. Often bad practices become institutionalized in the context of an industry, and initial queasiness gives way to industry-wide acceptance. As Chuck Prince, the head of Citibank, remarked about a year and a half ago in a line that's now been repeated a zillion times, as long as the music's playing, you got to get up and dance. For any firm to have abandoned, any bank to have abandoned the rewards promised by securitized subprime mortgages might have placed it at a large short-term disadvantage in the industry. And very few CEOs, very few executives are prepared to take those risks. Creeping industry precedent, this normalization of bad behavior, is very common. There are many, many examples of it. When, for example, in the late 1990s, accounting firms began to sell tax shelters that turned on some subtle interpretations of law, these legally suspicious tax shelters became finally embraced by the entire industry until it reached a point where people inside the accounting industry had the danger and the bad behavior, which they had a sense was bad behavior, normalized. It almost meant the end of KPMG. I think KPMG, which finally was late to that game, but engaged in it more vigorously as a result, almost went out of business. I think if there had been a big 5 accounting firms instead of big 4, if we hadn't lost Anderson already, KPMG would not be in existence today. And I've heard the chairman of KPMG make the same point. When in the early 1990s, to give you another example, investment banks first saw the research that demonstrated that an investment bank that had a particular corporate client also tended to have analysts who rated the stock of that corporate client higher than average, they weren't terribly bothered. They knew about it. Everybody knew about it. I remember talking with investment bankers during the 90s. But it was normalized in the industry. What? Professor Donaldson, are you suggesting that we shouldn't bring our analysts along in the roadshow to sell the corporate client? You're crazy. We'll be driven out of business. Everybody does it. And I tell you, these smart people, whatever else investment bankers are, they're smart people, didn't have a clue of what it was going to look like to the average investor when the news about the tie-in between analyzing stocks and the business deals that the investment banks had with the corporate clients were finally revealed, finally put on the front page of the financial press. Didn't have a clue. It had been normalized. That bad behavior had been normalized inside the industry. Tech shock is the last and third of the phenomena I want to talk about. When a transition occurs in ethical interpretation by market participants over time, it can often, especially if new technology is involved, be understood as the move from the use of rather opaque and general concepts to more specific ones. Now, in my writing, in social contract theory, I've used fancy terms to refer to these. In the beginning, as technology shocks our ethics, we tend to look at hyper norms, that is, very basic norms, love thy neighbor, or do unto others as you would have them do unto you. I mean, they're typically more specific than this in given problem context, but they're quite generic. And we don't know what to do, frankly, and it's only over time that we develop more particular procedures, interpretations, definitions, I call them micro-social contracts, to deal with those kinds of things. And I think that was very much afoot in the current financial crisis. But let's back up for just a moment to try to understand this phenomena. Clues to the phenomena can be understood, I think, by looking in other areas, for example, biomedical ethics. Consider the way in which modern medicine exhibits a recurring pattern over time. New medical technologies create ethical confusion, only later for the confusion to be abated as society develops new ethical precepts and practices. Think during the 20th century, for example, of the evolution of technology. Some of it seems pretty simple to us today that allowed people to live longer. I'm thinking now of feeding tubes, of respirators, of bottled oxygen, kidney dialysis, that kind of thing. Now, this new technology meant that not only did patients live longer, but they lived longer sometimes in contexts where it wasn't clear that even they were wanting to live that long. They may be unconscious. These situations, of course, this new technology created ethical challenges people didn't know how to deal with. How did they deal with it? Well, they did so the only way they could. They appealed to the generic concepts. One of the most common principles used in trying to look at those challenges were norms from the Hippocratic Oath, things like benefit and do no harm. By the close of the 20th century, though, more specific principles and practices had come to eclipse the generic ones. Debates still raged, but they did so over narrower and narrower areas of controversy. It's worth asking what precisely happened in this evolution of moral understanding about death and dying. The answer is that detailed processes and arrangements came to be substituted for the generic hypernorms. Chief among them was the right of people to adopt ex ante living wills, documents that specified more precisely what an individual wanted at the end of his or her life. The institutionalization of hospital ethics committees, new agreed upon definitions of death, and finally systems of code assignments for critically ill patients all played important roles. This ethical evolution spawned by the advent of new technology has occurred frequently in history. Inventions such as in vitro fertilization, animal cloning, and most recently the use of stem cells in research all provoked moral confusion at the outset, only later to give way to the development of specific principles and practices. So, in effect, we confront novelty at first with the only conceptual tools that we possess. Ones that are shaped to fit almost any dilemma. These are hypernorms. Later, we reach agreements about specifics. These are microsocial contracts. Consider the analogy of flying. Sometimes a pilot can know by GPS or visual memory his or her exact location and where he must guide his plane. Other times, he must proceed by compass and dead reckoning. That is, the process of estimating current position by utilizing previously known position, advancing that position based on known speed, elapsed time, and course, etc. When new economic technology, whether it's highly leveraged derivatives, as occurred in the late 80s, SIV, special investment vehicles, off-book entities such as the infamous Raptors used by Enron, and by the way, a heck of a lot of other companies that didn't happen to crash to the ground as Enron did, credit default swaps, CDOs, collateralized debt obligations, whenever they're introduced, we resort to the only way possible, that is, to our moral compass in a process of dead reckoning. It takes time, and only later do we develop more precise means of guidance. Consider the securitization in the economic crisis unfolding in front of our eyes. It bears all the earmarks of earlier clashes of new technology with general norms. This time, the new technology involves, among other things, the so-called securitization of debt, a novel, ingenious financial technique to allow routine financial obligations such as mortgages, credit card, auto loans, etc., to be repackaged into bulk units that are then sold as securities in a broader market. Now, these have advantages, by the way. There's a liquidity in the markets that is gained by securitization, which we ought not neglect. And by the way, this function of securitization is not going away. We will see it, even as the crisis finally unwinds. In recent years, a new form of financial alchemy took pools of mortgages, these are the securitized products, and bundled them for sale to investors around the world. In other words, people who bought these were, as you know, not just in the United States. They were in Germany, they were in sovereign wealth funds in China, etc. The bundle, in turn, was sliced into different tranches, each of which carried a different level of credit worthiness. The top tranches were to be paid first, and thus they had higher ratings than the lower ones. But the bundle products were notoriously hard to value, and this was true even before the limited markets for the products nearly vanished in 2008, a year ago. Methods of valuation for these highly sophisticated securities varied depending on firms. Different firms use different methods to value these securitized products. There was no uniformity and hence no agreed upon price. To make matters worse, these securitized products sold only rarely, making their market value opaque. I don't want to be too detail-oriented, but let me illustrate this with one example. Consider a particular security that in 2009 was trading, that is this year, trading at 38 cents on the dollar. So it's lost well over half of its value. The bond was backed by, and this is a particular instance I have in mind, 9,000 second mortgages from borrowers who put down little or no money to buy their homes. Nearly a quarter of the loans were delinquent, and losses on the defaulted mortgages were averaging 40%. But remarkably, this same security once had a top rating, AAA. Of course, we all know now that Moody's and Standard & Poor's botched their analyses of such securitized mortgages, but few, if anyone, I would submit, could have anticipated that the price of a security backed by home mortgages could fall 60% within a year or two. No one can reliably predict the outcome of the 2008-2009 economic crisis. But the manner in which society's ethical attitudes towards securitized loans evolve is likely to be similar to the way its attitude towards ethical issues sparked by other novel technologies have progressed. In short, we will over time substitute more tailored norms and practices in place of simple moral dictums such as avoid greed and don't take out loans you can't pay for. Already in 2009, a series of suggestions for new norms and practices have been made inside and outside the banking industry. In addition to higher capital requirements for banks, which will certainly get, and more direct regulation, they include industry norms requiring that issuing banks maintain, say, a significant portion, 20%, of the securitized products they market to others. What happened in the past, of course, they sold all this on. Still more, Bernanke and others have pushed for new measures to be taken by executives about the quality of the loans and due diligence that precede loans. What can we learn from these three ethical roots of the current economic crisis? That is, paying for peril, the normalization of bad behavior, and technology shock. The obvious backward-looking question of blame is obvious but unhelpful. We're business leaders, and yes, let's be honest, business educators, ethically responsible for much of this mess? And I think the answer has to be yes. They knew, or at a minimum should have known, of the tragic social dangers implicit in the three forces that we have examined. But the more important and forward-looking question is whether industry leaders and business educators have a responsibility to understand and deal with the three ethical forces we have examined. And the answer, I think, is clear. They do. They need to revise curriculums. They need to change radically the way people are paid inside financial services industry. Consider just one example, paying for peril. Investors, educators, and business leaders should push for new reward schemes that reflect long-term risk by paying over a longer term. And by the way, don't count on the government to limit executive pay. Over the past 2 decades, government attempts to rein in executive pay have been unblemished by success. There is always a way around it. The government probably has a better shot of doing this than the partially nationalized banks, if it comes to that. But almost none in the broader business sector, including financial services, such as hedge funds, security dealers, private equity firms. In the end, collective action is the only antidote to excessive government regulation. In the end, collective action and collective responsibility is the only antidote to crises like the one we're enduring. When Treasury Secretary Paulson gathered the heads of Wall Street firms together in the Federal Reserve Building in Manhattan in the fall of 2008 to push them to craft a collective solution to the Lehman Brothers meltdown, which of course they were unable to do, he appealed to this very sense of collective responsibility. Perhaps his particular solution was flawed, but his underlying concept was right. Industry participants, educators, managers, employees, we all have both a stake and a responsibility for the health of industry and for the health of society. Thank you.